Hello everyone. Guys, we are going to discuss today solvency ratios. In the last class, we discussed about liquidity ratios, right? So this topic is called solvency. So first we are going to discuss here what is solvency. Solvency means, guys, here we are going to check two things. We are going to check the ability of the company to pay not only its current liabilities, but also its long-term liabilities. So in liquidity, if you remember last time we discussed that there we measure the firm's ability to pay its current liabilities. But in solvency, okay, so we are trying to measure here, uh, we are trying to measure the ability of the firm to pay its total liabilities. Total liabilities means which will include current liabilities also and long-term liabilities also. And there is one more point. In liquidity ratios, our focus is to pay current liabilities, and that was short-term focus. But in solvency, our focus is to pay current liabilities plus non-current liabilities. So that is why it has long-term focus here. And here we are trying to see the ability of the company to survive over a longer period of time. Understood, guys? And here, please remember, whenever we will calculate the solvency ratios, so we will use the data from balance sheet also, and we will also use the data from income statement. There's a one more thing. Please remember, there are certain ratios of solvency. There we need data from the statement of cash flows. It means these three statements are important. We need information from balance sheet. We need information from income statement and from the statement of cash flows. Before moving to the ratio side, so let me tell you a few terminologies because these terminologies can be used interchangeably in your exam question. So first terminology is called what? Debt. So please remember, whenever you will see the word debt, debt means to say total debt. Total debt means say what? Total liabilities. Okay, total liabilities. So if they are saying like calculate debt to equity ratio or debt to asset ratio, so debt means to say total debt, or total debt means say liabilities, or liabilities means say total liabilities. Okay, so these four terms can be used interchangeably. Understood? So it means, what are the words? Debt or total debt is the same thing. Liabilities or total liabilities is the same thing, right? Or total debt, total liabilities is the same thing. Debt or liability is the same thing. Okay, so these four terms can be used interchangeably. One more thing, please, we also need to remember. Sometime, please, here we have a one more word, long-term debt. Sometime, in certain ratios, we will use only long-term debt. So when we talk about long-term debt, it means we are talking about only non-current liabilities. Only non-current liabilities. Understood? And in total debt, we take both liabilities, current liabilities and non-current liabilities. But in long-term debt, you will take only non-current liabilities. Okay. So long-term debt and long-term liabilities are interchangeable. So these two terms can be used interchangeably. Understood? And please, one more thing, remember here, if in exam, sometime maybe he will not tell you non-current liabilities, which are long-term debt. Okay, maybe he will not give you directly. So then how you will calculate? Obviously, it's very simple. So if you are provided with the information of total liabilities, I told you the total liabilities means both liabilities, current liabilities and non-current liabilities. Okay, if you are provided with the total liabilities, from total liabilities, if you will subtract current liability portion, this portion, so automatically what you will get? You will get non-current liabilities. So please remember, sometime in exam question, he may tell you total liabilities. From there, you can deduct current liabilities. So you will get what? Non-current liabilities. So then third thing you also need to remember, third word I'm telling you here, equity, stockholders equity, or total stockholders equity are again interchangeable terms, so they can be used interchangeably. So it means what I told you shortcut here. If they told you debt, it's, or if it told you liabilities, so debt means say total debt, and liabilities means say what? Total liabilities. So all these terms can be used interchangeably for terms. Second, I told you what? So we have, if we need, for example, long-term debt. So long-term debt mean to say long-term liability. Okay, so anybody can use long-term liability or liabilities. Okay. And the third word is what? For equity, he can use the word stockholders equity. He can use the word only equity, stockholders equity. Okay. Or he can use what? Total stockholders equity. So these are three same terminologies, okay, which can be used interchangeably. So now here we go. Uh, as I told you, here we have one now certain couple of points which we need to understand, and I need your concentration here, guys. Please remember, because our solvency ratios focus on this side. On which side? On capital structure side. This side on solvency ratios. Because in solvency ratios, sometimes we use total liabilities, which includes current liabilities and non-current liabilities, or sometimes we use only non-current liabilities, and we'll check total liabilities to equity or non-current liabilities to equity. That ratios I'll show you. Don't worry. The formula I will show you, but solvency ratios are applicable to this side, mostly capital structure. So this is called capital structure side, like debt plus equity is called what? Capital structure. Okay. So what does mean by capital structure? Like actually capital structure means how our company is financed. Okay. Company means to say the resources. Resources means say asset. Like how assets are financed. How much portion of debt we have used or how much portion of equity we have used to finance our assets. Understood? So this is capital structure. And please remember, now I'm going to explain what is debt and what is equity by definition, and then we'll move forward. So this is what is the first point is written. Capital structure decisions affect the risk profile of the firm. It is very true, because capital structure decision means to say, should we raise money from the debt or should we raise money from the equity, or we should use both in the capital structure. Obviously, this decision, the choice of debt or equity or both, will affect the risk profile of the business. So let me give you example here. For example, if there is a firm which is having a higher amount of debt, okay, obviously, so that company will become more risky. Why it will become more risky? Due to two reasons. Like if there is a company which is having more amount in the capital structure from the debt portion, so that company is considered as risky company. Why it is risky company? Why it is risky? The reason, there are two certain reasons. Number one, whenever in future, if you will take further loan, obviously the lenders, they will think that you have already a higher amount of loan in your capital structure. And so obviously if they will decide to give you further loan, so they will charge a higher interest rate, because they are taking high interest. They are taking high risk, right? So that's why they will charge higher amount of interest. And now what is the second reason why the more debt in the capital structure is riskier for the business? Now it is also riskier for stockholders, for equity holders, because as a shareholder, you will think this way: this company is having or carrying huge amount of debt, right? And obviously whatever company will earn like a profit, first they will use that profit to make payment of interest, right or wrong, and then anything which is left, that will go to stockholders as a dividend. So that is why, so whenever there is a high debt in the capital structure, so it will increase the risk of equity holder also. So that is why whenever there is a high risk for equity holder, so they will also demand high return to compensate their risk, right? So this is what is the first point I have already explained. And on the other side, if you will look another company, so for example, there is another company, so which is using more portion of equity, not of debt. They are using what? Bigger portion of equity in the capital structure. This one, not the debt. So in that scenario, that company is considered less risky. The reason, even if that company will go for the loan, so the lenders, the banks, they will lend the money at lower interest rate, because that company is having more amount from the equity, not from the debt, right? Or other way, if you are a shareholder, so you will think this way, that this company is not having the huge amount of debt, or they don't have a amount of debt, any loan of amount of loan. So obviously it means for shareholder, it is also risk, it is also less risky, because whatever company will earn, so it is more chances that shareholder will get the return for that, right or wrong? So that is why in that scenario, if company is solely financed by equity, or if company is using more portion of equity, that company is considered less risky for shareholders also, and they will demand less return because they are taking less risk. Understood? So this point I have already explained. Now guys, here, as I told you, this is capital structure, and capital structure always affect your risk profile of the business. Now, what is debt? Debt, simply like when the creditors, okay, they give the loan to the company. So that is debt for the company, right? Because company has to repay. So in simple word, debt can be defined as debt is the creditor interest in the firm. Creditor means a lender. It's the interest of lender, okay, in the firm because they have lent you the money. And why that is risky? Risky in a sense because on that it's like a contractual obligation, right? So you will enter into a contract with the bank, right? And as per your agreement, so you have to pay your interest and you have to make repayment for principal amount also, right? So this is what is the point here. That is why debt is considered generally risky for the business because it will create fixed kind of payments for the company, right? The company is obviously is liable to pay those amount of interest or principal repayment, right? So this is what is the point here. And please remember here, now, here we go. The firm is contractually obligated to repay debt holders because obviously it's a contractual obligation that you have to repay the money to the debt holders, right? So what do you have to repay? Obviously, maybe it's a repayment of principal amount, or maybe you have to pay the interest on that. And how much principal or interest you will pay back to the lender? Obviously, it will be defined under debt agreement, right? But there's a one advantage also if you're taking debt. What's the advantage? Because tax, whatever the interest you will pay on the debt, so that interest is tax deductible. Tax deductible mean to say what? It means whenever you are paying corporation tax, for example, if you are a company, right? So that interest, whatever you are paying on your loan, that can be written as expense, okay? As expense in the tax returns, whatever company will file with the tax authorities. And the tax authorities, they accept this expense, right? Whatever interest on accrual basis, so they will accept as expense. And if they're accepting this interest as expense, obviously it will reduce your taxable profit over which you have to pay tax. And if your taxable profits are less, obviously you will pay less tax also, right or wrong? Less tax also. So that is why we usually say the interest is tax deductible. So then what is the equity? Equity, how it is defined? So equity means to say obviously the money which we will raise through the issuance of shares, that is called equity. So equity is the ownership interest in the firm. Okay, what I told you about debt, I told you debt is the creditor interest in the company. Okay, but equity is the ownership interest in the firm. Obviously, if you are a especially ordinary shareholders in the British term, so American people call it common stockholders, common shareholders. Okay, if you're a common shareholders, it means you are considered as a owner of the business, right or wrong? So that is why equity is the ownership interest in the firm, right? So this is also a point of equity. Equity is the permanent capital, right? Because you are not contractually responsible to pay back the principal amount of shareholders. No, no. So equity is a kind of permanent capital of an enterprise, right? So it is contributed by the firm's owner. Owner means by the shareholder in the hopes of earning a return. Because shareholder, they always expect that with the passage of time, they will also get the dividend plus maybe share price will also increase. So they will have opportunity to make capital gain as well. Understood? And please remember, on shares, whenever company pay dividend, or I'm talking about on ordinary shares, so the dividend is not fixed. Okay, because it's not kind of contractual obligation. Dividend is not fixed. It is totally or solely the discretion of directors, okay, to decide how much dividend they want to pay. So if they wish to pay higher dividend, so they can pay it. Okay, they can pay it. If they don't want to pay higher amount of dividend, so they can reduce it also. But being a shareholder, you cannot protest against the company, or you need more dividend. No, it's not like that. Understood? So here dividend is not a fixed commitment of the company. No. So here we go, guys. And what is dividend? So here dividend is defined. Obviously, whenever company earns a profit, right? So from that profit, some portion of the profit is distributed among the shareholders. So that is called what? Dividend. So here we go, guys. Now we are going to start with the example, obviously, and then I'll do at the end practice question as usual. You will get the idea how this topic will be tested in your exam. So here we have a balance sheet again. Okay, so here we go in balance sheet. This is the resources side. Resources side means say asset side. And this is financing side, mean to say debt plus equity side. And we know as per accounting equations, our assets are always equals to debt plus equity. Now, here we have a current year data, prior year data. I'm just going to go through first asset side. So in the current assets, we have here, for example, cash and equivalents available for sales securities like investments in the stock or bonds of other companies. So then we have account receivables, note receivables, inventories, prepayments. So these are our total current assets of the current period, and these are the total current assets of prior period. Then we have here non-current assets. For example, we have a equity method investment. It's a kind of investment again when you buy the stock of other company. Okay, your percentage is more than 20%, but less than 50%. So that you can consider in the equity method investment. But that topic is not the part here. So just I'm telling you, this is like a non-current asset. Then we have a property, plant, and equipment. There's the cost of PPE. Then we have accumulated Okay, guys, then we have here, I hope so. Sorry, there was a small interruption. So now we have here other side, which is financing side. Here we have a current year data, last year data. Here we have a current liability section. We have accounts payable, notes payable, accrued interest. We have a current maturities of long-term debt. Okay, accrued salaries, income tax payable. So these are all your current liabilities of the current period. So these are your current liabilities of the last period. Then you have your non-current liabilities. Okay, in which we have a bonds payable, long-term notes payable, employees related obligations, deferred income tax. These are tax related liabilities. Okay, it's deferred tax. So if you will make the total, so this is the total of non-current liabilities of the current period. This is the total of non-current liability of the prior period. And here we go then. We have here total liabilities. Total liabilities, how you got? Obviously, if you will add current liabilities plus non-current liabilities, this is called your total liabilities. Okay, again, we have a current liabilities plus non-current liabilities. It is your total liabilities. And then we have here stockholders equity item. We have here preferred stock, common stock, additional paid in capital, retained earning. I hope so you have idea about these things, what these things are there. So this is the total equity of current period. This is the total equity of last period. Now what to do now, guys? So now if you will add total liabilities, this total liabilities includes current plus non-current. And then if you will add this total of the equity, so this, if you these two value you will add. So this is called total liabilities and stockholder equity. And obviously it should be equal to the asset. And same here you have again we have a total liability, which includes current liabilities plus non-current liabilities. And then if you will make the total with the equity, these two values, if you will add, so this is what is your total liabilities and equity of last period, and it should be equal to the asset side. This is balance sheet. And here we have some data of income statement also, for example. So this is the income statement, guys. We have here net sales. Net sales means the sales minus sales return of current period, prior period. Then we have a cost of goods sold. From sales, obviously, we deduct cost of goods sold equals gross profit. Then we deduct selling and admin expenses. So this is equals operating income. Then we add other revenues and losses. Other revenue will be all added, obviously, losses will be deducted. So then this is called earning before interest and tax. Then you have to take interest expense. You will deduct. This is called earning before tax. Then deduct income tax. This is called your net income. So I hope so you have idea about financial statements. So now let's move to the ratio side, which is the topic of the day. So guys, please, I need concentration here. So first ratio of solvency we are going to discuss. Okay, solvency ratio. First ratio. First ratio is what? Total debt to capital ratio. Total debt to capital. So total debt means to say, guys, please remember here, don't make mistake. It means this, the ratio itself is a formula. So formula is what? Total debt divided by total capital. Okay, this is the formula, total debt to total capital. Okay, so let's first understand the formula. What's the formula? So we'll write total debt as a numerator and we will divide with the total capital. Please remember, guys, in total debt, we have two things. We have a current liabilities plus non-current liabilities. Okay, both. And then in total capital, we have what? We have all liabilities including current liabilities plus non-current liabilities plus equity. So if I add current liabilities and non-current liabilities, this is debt, right? This is debt, right? So I can say this way, total capital mean to say debt plus equity. Okay, so this is the first ratio which we can use to measure the solvency position of the business. Okay, so here we go. Let's understand first from where to pick this data. So we need total debt and total capital. So we'll go back to the question because this both information you can find in the balance sheet. Just go to the balance sheet. So this is the balance sheet in front of you guys. So we need total debt. So total debt means this is the total debt value. This is total debt. I'll take total debt of current period. Okay. And then I'll take total debt of last period. Obviously, if I'm working with the current period ratio, I'll use this total debt. If I'm working with the last year, I'll use this as a total debt. Okay. And I'll divide with the what? I'll divide with the total capital. Total capital means say what? This is total capital. Total capital means say liabilities plus equity. Okay. This is called total capital. It means what are the formula? So I'll take in the first year 1 million, which is it's a current period. I'll take this value 1 million total debt divided by total capital. This is total capital. Please remember total capital can be written as total asset also because capital includes what? Debt plus equity, and debt plus equity is always equals to your asset. So please remember, so this ratio, which is called debt to capital ratio. So this is also called debt to asset ratio also. It's the same name. Okay. Same name. Please don't make it okay difficult. So it's the same thing. Debt to capital means a total liabilities divided by debt plus equity. And here same thing. Debt to asset means a total liabilities divided by assets. Assets means a what? Capital. Right or wrong? Because as per accounting equation, assets are always equals to debt plus equity. So here we go. If you're calculating the ratio of the current period, so with two values I'll divide. Current period, I'll take this total debt divided by this debt plus equity. In the prior period, I'll take this value total debt divided by this debt plus equity. Now I'm moving there and I will show you. So here this is how it is calculated. Okay, see here. So we have taken total debt, I mean say total liabilities divided by debt plus equity. Okay, and in the prior year, I'll take total debt of prior period divided by debt plus equity of the prior period. Okay, and what is the answer now? Please, here we go. If you look at here answer is what? 0.594. If you want in percentage, you can just multiply with the 100 also. So you can get answer into percentage also. So if you will multiply this value with the percentage, okay, with the 100, so you will get 59.4%. And same you can multiply with the 100. So you will get what? 55.6%. So see what happened. This is the last year data. It means now look at here. Last year, your total debt was 59.4% of total capital amount. Okay, and this year, your total debt is 55.6% of total capital amount. Like in simple words, we can say this way also. This way that your debt amount is 55% of total asset value or total capital value. Right? Now, if you look at here, guys, so last year your answer was how much? 59.4%. And this year answer is 55.6%. So please remember here, if answer is increasing over the year, so that is more dangerous for the business, right? But if answer is decreasing, that is good sign for the business. Here answer has decreased, right? Because this is your last year data, this is your current year data. So answer has decreased from 59% to 55%. Although if you will just look at the liabilities have increased. See, liabilities has increased from 950 to 1 million, but your answer has decreased. Why? Because there is a greater change in total capital, bigger change in total capital than change in debt. Understood? It means even liability has increased, but your capital also has increased. So increase in capital is bigger than increase in liability. So that is why your answer has reduced. Understood? So this is what is called total debt to total capital ratio. So this is also called, I told you, total debt to total asset ratio. It's the same ratio. Understood? Whenever this ratio is low, if this ratio, whenever you will calculate it is low, it means more of the firm's capital is supplied by the stockholders. If answer is less, for example, if answer is, let's assume one answer is 90%, other answer is 10%. It means here your capital, your total amount, okay, or your 90% of your total capital is supplied by the debt. But in this 10% of the capital is supplied by the debt holder. So less answer is desirable. Okay. So if answer is less, it means your company is less risky. If answer is more, it means your company is high risky because you are using bigger proportionate of debt in your capital structure. Then we have another ratio also, guys. If you look at it, so here this ratio is called debt to equity ratio. Debt to equity ratio. And here this name of the ratio itself is a formula. So it means here you will keep total debt as a numerator and will divide with the stockholders equity. And I told you here, guys, here total debt means you will take both liabilities, current liabilities plus non-current liabilities. But here that now the denominator is only the equity. Okay, don't take debt in the denominator here, only you will take equity. Understood? And here please remember, let me show you first which value you will pick from the balance sheet. Go back to the balance sheet. Now you will use these value, please. You will take this. These are your total liabilities divided by this your total of equity. And here, this is the current year. And then you will take total liabilities of the last year divided by total equity of the last year. So this what is the ratio you will use here. Understood? So this is current year data, 1 million, which is total debt divided by equity of the current period. Okay, so you will get 1.25. You can convert into percentage also. It's your choice. And then prior year data. So you can take 950. This is the 950 is the total liabilities of the last year, and this is the equity value of the last year. So answer is 1.4. So if you will here just if you will look at here, so what it means again, less answer is desirable, not more. Okay, for example, if you will look at here is answer is 1.46. So 1.46, if you want to convert into percentage, just multiply with 100. So 1.46 multiplied by 100, it will give you how much? 146%. Then if you will convert into this percentage, so this will give you 125%. So what does mean by 146% here? 146% means that your debt is the 146% of equity value. You can assume here equity is 100%, but your debt is 146%. And here your debt is 125% of equity value. Obviously, if that is more, it means company is more risky. Understood? So this is what is, guys, another ratio, which is called debt to equity ratio. Now the point is that in exam question, you have to think clearly what you have to calculate. For example, most probably he will tell you which ratio you have to calculate and he will supply you the formula. Maybe he will ask you to use total debt to capital, which is also called total debt to asset, or maybe he's saying that no, use debt to equity ratio. Understood? That ratio you will calculate, and then I'll go to the analysis part, don't worry. Then there is another ratio, guys, which we can use also to measure solvency. That is called long-term debt to equity ratio. Long term. So guys, this is actually the name of the ratio itself, a formula. So long-term debt means say we will take long-term debt as a numerator and we will divide with the equity value. Here, please, long-term debt means say only non-current liabilities you have to take. Don't take current liabilities here. Only non-current liabilities. And we will divide with the equity value. Okay. For example, now if you will go back to the balance sheet, this is balance sheet in front of you, guys. Let me remove this. Now we need long-term debt and equity. So long-term debt means only non-current liabilities. So this is the total of non-current liability of current period. This is total of non-current liabilities. And I'll divide this value with the total equity. And this is the last year non-current liabilities and divided by total equity. Understood? So this is how you will pick the values. These values we have used here, guys. So this is the last year non-current liabilities and last year equity. This is the current year non-current liabilities, current year equity. And if you will solve it, so you will get these answers. You can convert into again into percentage. It's your choice. Multiply by 100. It will give you 76.3%. And if you will multiply this value, it will give you maybe 10. How much it is? 1.038 times 100. So it is going to be 103.8%. Okay. So it means, look, it means now what you are checking? You are checking your debt with comparison to equity. Okay, now how you will interpret it means last year your debt, long-term debt, was 103% of equity value. Okay, and this year your debt is 76.3% of equity value. And obviously, again, lower answers are desirable. So why answer is lower? Maybe company has repaid some amount of debt, right or wrong, in the current period. That is the answer has reduced, right? So this is what is the possible reason. So there are three ratios I told you so far, right? So we discussed first ratio, what? Debt to asset. First ratio I told you, debt to asset ratio. Debt to asset. That means say current liabilities and non-current liabilities. Assets, it is also called debt to capital ratio. Capital again means say what? Debt plus equity. This is capital. Okay, this is called debt to asset ratio or debt to capital ratio. Understood? And then second ratio I told you, debt to equity ratio. Again, this debt includes current and non-current both. And third ratio I told you, long-term debt to equity ratio. Long-term debt means only non-current liabilities you have to use. Okay. Now here we go. Now guys, we have certain points which I want to tell you here. Okay, this I already told you. Debt to total asset ratio. It's the same ratio which we calculated. Debt to capital ratio. It's the same thing. Okay, just they used another time the name, but it's the same ratio. And you can just cross check, it's the same answers also. Okay, because debt to asset. Asset is always equal to debt plus equity, right? Assets are always equal to debt plus equity. So it means I can say debt to total asset ratio or debt to capital ratio. It's the same thing. Okay, guys. And now here we have some question from their question may arise in your exam. This is what these kind of uh, analytical questions they will ask you. Please remember here, guys, here I'm going to tell you here the relationship of two ratios. Debt to equity ratio, this is the one ratio. And second is what? Debt to asset or debt to capital. So these two ratios always have direct correlation. You know what does mean by direct correlation? Direct correlation mean to say the both ratios moves in the same direction. For example, if debt to equity ratio will increase, this ratio will also increase for sure. If this ratio will decrease, this ratio will also decrease. Okay. Even see here denominator is the equity, here denominator is the assets or capital, but they have direct correlation. When there is an increase in one ratio, other ratio will also increase. If there is a decrease in one ratio, other ratio will also decrease. So let's have a look with the help of example why it is like that. Okay, because they will ask you the question. These questions they will ask you in the exam. Okay, like they will ask you, okay, if there is increase in debt to equity, what will the effect on debt to asset ratio, or which ratio will be affected? So you should tell like debt to asset ratio will be factored and it has direct relation. If this ratio will increase, this ratio will also increase. If this ratio will decrease, this ratio will also decrease. Okay, so here we go. I'm just showing you with the help of example, like why it's like that. For example, let's assume we have a total debt of 10. Total debt, it means it includes current liabilities plus non-current liabilities. And then we have a total equity of 10. Okay, so two values I'm using here. So we have a total debt of 10 and equity of 10. Okay, if obviously if I'll add these two values, debt plus equity, so this is called what? My total assets also, right? It means my total assets are $20, right? Because debt of 10 uh, dollar of debt, $10 of equity. So my assets are also $20. Okay, as per accounting equation. Now here we go. Let's find out two ratios. First, I'm calculating debt to equity ratio and debt to total asset ratio. So when I'll calculate debt to equity ratio by using current data. So I'll take debt, which is 10 as a numerator, divided by equity, which is also 10 as a denominator. Multiply by 100, it will give you 100% answer. As per this data, it means what? Your debt is 100% of your equity value. And if you will calculate debt to total asset ratio. So my debt is $10, which is given here, and my total assets are $20. Okay, $20. So 10 over 20 multiplied by 100, answer is 50%. It means my debt is the 50% of my total asset value. Okay, great. Now what happened? For example, if debt, now this is the same example I'm continuing. Let's assume this is the data. And I'm saying that what if debt is increased by $5? So what will happen? This debt will move from 10 to 15, right? And obviously this equity will remain unchanged because denominator is equity. That will increase by 5. Like old debt was 10. If in this 10, I'll add 5 because it's increased by 5. If I'll add 5, so it will be 15. But equity is unchanged. So 15 over 10 multiply by 100. So answer became 150%. You know what happened? What it means? It means your debt value is 150% of equity value. Okay. So now same way calculate this ratio also. This debt will also increase because numerator is a debt increased by 5, so it will be 15, and denominator will also increase by 5 by because total asset mean to say debt plus equity, right? And previously debt was 10 and now it is increased by 5, and equity is 10, which is unchanged. So total is how much? 25, right? So this what is the denominator? 25. So 15 over 25 multiplied by 100, answer is 60%. So see what happened. This ratio moved from 100 to 150%. This ratio has increased. And this ratio also has increased from 50 to 60%. It means both ratios has increased, right? If that will increase. So this is what it means. Now let's prove other way. For example, now I'm assuming that. Now let's assume again with this situation I'm adding. Let's assume your debt is decreased by $5. It means previously debt was 10, now decreased by 5. If you will decrease by 5, it will remaining debt will be 5, right? And your equity will remain unchanged 10. Okay, 5 over 10 multiplied by 100, it will be 50%. So see, previous ratio was 100, now it is 50. So ratio has decreased. Okay, great. Same way calculate this ratio, debt to total asset. Previously, debt was 10, now decreased by 5, so debt will be 5. And previously, total asset was 20. Now it will be 15. Why? Because total assets include debt plus equity. 10 debt and 10 for equity. Total was 20. But now debt is reduced by 5. Reduced by 5. So debt is 5 and equity is 10. So debt plus equity will be how much? 15 now. So this is 15. So 5 over 15 multiplied by 100, answer is how much? 33.3%. See, this ratio has decreased from 100 to 50, and this ratio also has decreased from 50 to 33. It means it has direct relation always. Okay, guys? I hope that is clear. Whenever debt to equity ratio will increase, so debt to asset ratio will also increase. If debt to equity ratio will decrease, debt to total asset ratio will also decrease. So this is the statement which you have to remember. Just actually to prove this statement, I just show you some calculation. Otherwise, being a student, you should remember this statement. What? Debt to equity ratio, it's a one ratio, and debt to asset ratio, they always have direct correlation. Correlation. There is a relationship. Okay. So they both ratios, they moves in the same side. Okay, okay. So what it means, like if one ratio will increase, other will also increase. If one will decrease, other ratio will also decrease. Okay, guys, I hope so it is clear. Now, guys, here we have here there is another note. This point is also tested in your exam. So I already told you, so debt to equity ratio always is always it will be higher, or I'm using word debt to equity ratio will be higher, or maximum it will be equal to debt to asset ratio. Most probably. Okay. Most probably, for example, assume here you are using debt divided by equity, and here you are using debt divided by asset. Asset means say what? Asset means say debt plus equity. Right or wrong? Here you have a small denominator. Here you will have a big denominator. Here your answer always will be higher, and here your answer will be lower. Or maximum, if there is a company, I told you what, debt to equity ratio is always higher, or it could be equal to debt to asset ratio. Why or how it could be equal? Okay, higher we understand that here denominator is small, here denominator is bigger. So that's why here ratio will be higher, here ratio will be lower. It's fine. But how it could be equal? Yes, it could be equal. If there is a company which is totally financed by equity, there is no debt. So it means here asset will also include only the equity portion, right or wrong? Because that company is not having any kind of debt. So in that scenario, your debt to equity ratio and debt to asset ratio will be equal. This is another ratio. Okay. Another point, please remember. Debt to equity ratio could be higher or equal than debt to asset ratio. It can never be lower than debt to asset ratio. Please fix in your mind. Now, guys, we have another ratio which is called what? This is the now I believe fifth ratio I'm discussing now. Earning coverage ratio. Okay. Earning coverage ratio. Earning coverage ratio. Earning coverage ratio is also called, guys, please, it is also called earning coverage ratio. It's a one name, and it is also called interest coverage ratio. Which coverage? Interest coverage ratio. And it is also called, please, times interest earned ratio. Three name you can use. Okay, interest coverage ratio, earning coverage ratio, okay, or what, times interest ratio. So most famous name are times interest earned ratio and interest coverage ratio. Interest coverage, so it means same ratio you have to calculate. So if you are calculating times interest earned ratio, so what is the first understand what's the formula here. Actually here we need data from income statement only. Okay, for this ratio from income statement, because the numerator is earning before interest and tax. Earning before interest and tax. Earning before interest and tax is also called profit before interest and tax. And obviously this value you will find from the income statement and divided by the interest expense. Okay, this value you will also find from the income statement. Understood? And let's have a look what it means. And this ratio will give you answer in times. For example, let's assume my earning before interest and tax is $10 and my interest expense is $5. So 10 divided by 5, it is what? 2 times. Answer is 2 times. What it means? It means my profit can pay 2 times the same amount of interest, or same amount of interest can be paid 2 times by using my profit. Okay. So that is what is called times interest ratio. Okay. Again, here higher answer is desirable. Higher answer, because this ratio is really, really important for lenders, for creditors, those who want to lend money to the bank, like lend money to the company, like a bank. Okay, so they will always look into this ratio, because they don't want to give loan to that company or to such company which cannot pay interest later, right? Because this is the priority of the bank. They should recover the interest, because this is their kind of investment, right or wrong. So that is why this ratio is really, really important. They want to see the ability of the companies to pay the interest expense, that how many times they can pay the amount of interest from their profit. And here we have a certain points to remember, guys. Please remember here. Here we have a one or 2 points to discuss here. For example, they are saying that for the ratio to be meaningful, net income cannot be used. Don't use here numerator as a net income. Always use earning before interest and tax, which is also called profit before interest and tax. Okay. EBIT or PBIT, it's the same thing. That you have to use. Don't use here net income. Second, please remember here. Uh, Here in the denominator, you also need to remember in denominator, this is the interest expense. Please, guys, sometime some portion of the interest is also capitalized. I'm not sure if you have idea about it or not, because sometimes we take a loan, from the bank, okay, to construct the asset or maybe to buy the asset. So that loan, the interest on loan, we can capitalize as a part of cost of asset. If you will capitalize some portion of the interest, if you will capitalize the part of cost of asset, obviously that interest is showing in the balance sheet, not in the income statement. Please remember, when you calculate this ratio, whatever the amount of interest which you have capitalized, which have been the part of cost of asset, that interest, please, it should be here. It should be added here with the interest which is showing in the income statement. So this is the point. Maybe in exam question, he will tell you interest expense in the income statement. For example, interest expense in the income statement is $10 and amount of interest in the balance sheet is $5. It means total interest you have to write 15 here. So this is what they're saying. Denominator should include capitalized interest also. Okay. And here higher answer is desirable, not the lower one. And obviously this data from where we are taking. This is the earning before interest and tax of the current period. This is the interest expense. Okay. I'll show you these value. These value you will get from the income statement. Like for example, this is what, if you are talking about current period. So this is your numerator, earning before interest and tax. And this, the interest expense, is your denominator, like 150,000 divided by 15,000. So you will get answer in times. Okay. Then here 120, this is for last year, 125,000 divided by this interest expense of 10,000. This will give you answer in times. Okay. And now here we go. So these ratios are here 10 times, here 12.5. Last year it was 12.5 last year. Okay, it means last year your profit can cover same amount of interest 12.5 times, but this year your profit can cover interest expense by 10 times only. So if answer is reducing, that is not good sign. Okay, coverage ratio should be more. Why answer has reduced? There could be a couple of reasons. Maybe your interest expense has increased because denominator is what? Your answer can reduce or can increase due to certain reason. Number one, for example, if your profit before interest and tax will decrease, right or wrong, obviously this answer ratio will decrease, right or wrong. Or if profit before interest and tax will increase, answer will increase. Or if interest expense will increase, obviously this answer will decrease. Or if interest expense will decrease, this answer will increase. So you have to remember possible reasons. Okay, now guys, we have here 2 to 3 more ratios, and then I'll show you exam questions, how questions will be tested in your exam. So here we go. Guys, there is another ratio which can be used also, that is called earnings to fixed charges ratio. Earnings to fixed charges ratio. It is also called fixed charge coverage ratio. It's the same thing. So first understand what does mean by uh, fixed charges and earnings. Here guys, earnings don't take only let me just guide you here. Please remember here. So first, let me tell you what does mean by fixed charges. Okay, let me explain this word first. Fixed charges mean to say the kind of fixed amount which you have paid in the current period. Okay, like it includes mainly three things: fixed charges, interest, because this is your fixed amount you have to pay, and required principal repayment of loan, which is also fixed, you have to pay, and the required principal amount of lease, which you have to lease. Sometimes you are taking assets on lease. So all these three are your contractual obligations. Interest you have to pay. Okay, principal you have to make repayment of loan, and you have to also make repayment of lease, right or wrong. So if you will add these three things, interest plus principal repayments of loan plus lease repayments, so this is called fixed charges. This is called fixed charges. Okay, this is the definition of fixed charges. And here students, they make mistake again. I'm telling you fixed charges means three things: interest, principal repayment of loan, and lease repayments. These three things is called fixed charges. Now, what is the numerator? Numerator is what? Earning before fixed charges. See, guys, it is not earning before interest and tax only. No, no, no. It is earning before fixed charges and taxes. And I told you in fixed charges, there are three things: interest, principal repayment of loan, and lease repayments. Right or wrong? Payment for leases. Right? These three things are fixed charges. It means here we need up earnings, which should be before fixed charges and before taxes. And denominator is fixed charges. Fixed charges, again, it means interest, principal repayment of loan, and leases. Now, the point is how denominator will be calculated and how numerator will be calculated. Because the same denominator is written here also, fixed charges, in the numerator also. So that's why denominator, I already told you will add three things: interest plus required principal repayment of loan and payment for leases. If you will add these three things, this will become fixed charges, which will become your denominator. And let's assume if leases are not given, put 0. And if principal repayment is not given, that you can put 0. Whatever three out of these three is given, just add those three, okay, and divide here, fixed charges. Now, what is earning before fixed charges and taxes? How you will get numerator? So this is the calculation way, how you will calculate the numerator. Please remember, guys, earning before fixed charges and taxes. This is the numerator I'm talking about now. So you will always take net income. I hope so. Net income, net income, it's the last value of the income statement, which is net income, right? Net profit. So net profit you will add back tax expense, which is showing in the income statement. Then you will add back interest expense, which is showing in the income statement. Plus, you will add back principal amount of loan repayment. Obviously, this value will not be given in the income statement. Maybe this amount of loan repayment you have to check from the cash flow statement. Okay, then repayment of lease. Maybe for this, you also need to check cash flow statement. So if I'll take net income from the income statement, plus tax expense, plus interest expense, plus principal amount of loan repayment, plus principal payment of leases. So this is called earning before fixed charges and taxes, which I will take as a numerator. Now let me show you example A. For example, this we have a income statement data. Let's do. Okay. This is the income statement of year 1 and year 2. For example, here we have a net sales, cost of goods sold equals gross profit minus selling expense equals income from operation minus interest expense. Okay, plus or minus other income or expenses. Okay, this is if it is deducted it's expense, if it is added it's income, then it is income before income tax, and then we'll deduct income tax expense, we got net income. So now the point is that then we, for example, here guys, how you will calculate first, because the numerator is I need earning before fixed charges. So how I'll calculate? I'll take guys net income. Please understand net income, which is how much of current period, which is year 1 or 2? Year 2. Okay, it's year 2 means a recent current. So I'll take net income, which is 1103. I'll add back tax expense, which is written here 444. I'll add back interest expense, which is given here, plus interest 319. I'll add back principal repayment of loan. It is not given in this income statement, obviously, but I am assuming here as per the question data. So we are assuming there are principal repayment of loan in year 2 is 200. Okay, this we are assuming just. We'll add back plus lease payments. And we are assuming we don't have any lease payment. So if I will add all these things, this is called earning before fixed charges. If I'll add all these things, this is called earning before fixed charges. So see, all these things are added here. Okay. And then what are the fixed charges? Fixed charges means what? Interest. If I'll add all these things, guys, please don't forget it is called earning before fixed charges and taxes. But if I'll add only these three things, these three: interest, principal repayment, and leases, this is called fixed charges. So it means I don't have a lease here. By the way, I have interest and principal repayments. Principal repayments I have assumed. Okay, it's not given in the income statement, but if it is given, just take it. If not given, put it 0. I'm assuming in this ratio that there is a principal repayment. It means if I'll add these three values, it's called fixed charges. So now I'll divide with the fixed charges. So these two amounts, 319 and 200. If I'll take earning before fixed charges and taxes, which is this numerator, divided by, for example, the denominator. Denominator is fixed charges only. So this will give you 4 times. What it means? It means, now let's understand what does mean by this ratio. It means this is actually the earning before fixed charges and taxes. So you can see if I'll use this profit to pay fixed charges, for example, if answer is 4 times. So it means if I'll use this profit, which is before fixed charges and taxes, to pay our amount of fixed charges, so we can pay 4 times the same amount of fixed charges by using the same earning. Understood? Or if answer is 5 times, it means earnings before fixed charges and taxes can be used 5 times to pay same amount of fixed charges. If answer is 10 times, it means earning before fixed charges and taxes can be used 10 times to pay same amount of fixed charges. And obviously higher answer is desirable, guys, because you should have a more profit, okay, to pay fixed charges. Then we have another ratio, guys. Please remember, there's another ratio I'm going to show you now. Another ratio, this ratio is called what? This is the last ratio of solvency, guys, and then I'll take you to the questions and I'll show you how questions will be tested. So last ratio is what? This is called cash flow to fixed charges ratio. Cash flow. So it means what is the what's the difference here? Please, previously we discussed here fixed charges coverage ratio previously, and there we used earnings before fixed charges and tax divided by fixed charges, but here formula is different. So we are going to use cash flows. So how you will take numerator? So cash flow to fixed charges. Fixed charges are 3 things I told you already: interest, principal repayment of loan, and leases. This fixed charges, but here I need cash flow. How? The numerator will change now. I'll take cash flow from operation. This value I'll get from the cash flow statement. You know, the answer of in the cash flow statement, there are 3 activities, right? Cash flow from investing activities, financing activities, and operating activities. Actually, there is a first activity, which is cash flow from operating activities. So this value, I'll take that value, cash flow from operating activities. Okay. Then I'll add fixed charges into that. Fixed charges means what? Again, interest, prepayment of principal amount of loan repayment and leases, and then I'll add tax. Obviously, this value I can get again. Interest I can get from the maybe income statement also, but loan repayment, lease information I'll get from the cash flow statement. Tax payments I'll take. Okay. So by the way, all these things you can take in this ratio, you can get these ratios, all these fixed charges, amount of interest paid, amount of loan repayments, amount of lease payment, you can get from cash flow statement itself. You can get it from there. Yes, you can get it. And then tax payment, not expense, tax payment. Whatever tax you have actually paid, this you can also take from cash flow statement. Okay. So what I'll do, I'll take cash flow from operation plus fixed charges plus tax payments and divided by fixed charges. Okay. Divided by fixed charges. So this is called cash flow because you are using cash flow data. Okay. To fixed charges ratio. Understood, guys? And please, this cash flow from operation, this amount is already after tax value, already after tax, because this is the final value of cash flow from operating activities, right? The tax is already deducted. So that's why it's just written after tax. Okay. Then you will add fixed charges, then it is tax payment and divided by fixed charges. Okay. Again, for example, if answer is 5 times, it means if I use my cash flows to pay my fixed charges, it means I can pay 5 times. So again, higher answer is desired. Understood? So now guys, here we have a small example. I'm just continuing here. For example, here we have a, now let me tell you here, this example data I'll take also. This I'll take also. This is the income statement data you remember, right? Understood? So what we did there, we already calculated, right? Earnings before fixed charges and interest, right? So this data, and then we have here, I'll show you here. Then we have a cash flow statement data also. There we have a cash flow statement actually. This is the cash flow statement, okay? For example, cash flow from operating activities, this is the first activities. So we have a cash receipt, cash payment is net cash provided by operating activities of year 2 of year 1. You know, the numerator was cash flow from operation, first value. So this value you will pick. Then you have a cash flow from investing activities. We have a purchase of PP, other investment. So this is net cash used in investing activities. Then we have a cash flow from financing activities, which includes issuance of common stock. I am assuming you have idea about cash flow statement, issuance of debt, reductions of debt. Okay, like repayments, payment of dividends, etc., repurchase of common stock. So this is all cash provided by financing activity. This is financing activities total. Okay. Now, what was the ratio formula? Please, here we go. Ratio formula was, now try to understand here, guys. Cash flow to fixed charges, how you will calculate. So you need cash from operations. Operation means these values. This is cash flow from operating activities. If I'm doing only year 2 data, so I'll do only year 2. This is the cash flow from operating. That cash provided by operating activity. This is called cash flow from operating activities. So this value I'll pick 1503. Then I'll add what? But I'll add fixed charges. You know what was fixed charges? Fixed charges include interest plus loan repayments plus lease. So lease we have already assumed 0. Loan repayment was 200 in year 2, and interest, let's confirm from the income statement what was the interest, because we just assumed previously, na? Here we calculated, na? So we have a year 2 data, right? This is the fixed charges, right? 319 and 200. 319 is for interest, you can see here. And 219 were principal repayments of loan. And we have assumed leases is 0. So fixed charges 319 plus 200, it is 519. So this is the fixed charges value. So this is what we are using here, fixed charges. This is fixed charges. And this is cash flow from operating activities. Plus tax. This is the tax. Just cross check. Tax expense. This tax expense is not given in the cash flow statement. So that's why it's not given here, right? In the operating, you can see here. Is there any tax payments is given? No, not given. If you will go through here, look into this section. Do you have any? This is operating activity. Any tax payment? No. If it is not given, obviously we can take value from the income statement. So we'll assume this expense is equal to payments. This is the tax expense 41444. Okay. So 444. So this value you have taken from cash flow statement. Let's see again. This is cash flow from operation. This is fixed charges. This is tax payment. If you, this is numerator. This is called cash flow plus fixed charges plus tax payment. Then divided by only fixed charges. Fixed charges means this value. Fixed charges you will divide. So answer is 4.8 times. It means if you will use cash flows to pay fixed charges, how many times you can pay? 4.8 times. Okay, guys. So now I'm going to show you question, how question will be tested from this ratio. So need concentration. Please, here we go. We are going to start with the first question. So always try to read the requirement first. So they're saying that annual coverage of firms debt. Whenever they're saying coverage ratio, debt coverage means interest coverage ratio you have to calculate, which is also called times interest coverage ratio. Interest coverage ratio. Do you remember what was the formula? For interest coverage ratio, the formula was profit before interest and tax divided by interest expense. And make sure if you have any capitalized interest, that should also be the part of interest expense here while you calculate this ratio. So here we go. Now let's read the question. They're saying a firm earned 10,000 before interest and tax. Yes, one value is given. So I need this 10,000 as a PBIT or EBIT. Okay. And has 30%, 36% tax rate and has the following debt. This is already EBIT is given. Earning before interest and tax, a profit before interest and tax. Numerator I have. Now what I have to work? I have to work with the denominator. Denominator is interest expense. And here they are telling you the company has the following debt. These liabilities are there. So they're saying there's a first mortgage bond. There's a one type of bond. Rate of interest is 9% and amount of loan is 5,000. So it means how I can calculate interest? I'll take 5,000 multiply by 9%. So this will give you amount of first interest. Let me recheck it. 9,000 into 5. It is going to be 450. Is the one amount of interest expense. Then second, we have a loan. Again, we have a debentures. Value is 10,000. On debenture, we have interest rate of 10.2%. If you will take, it will give you 1220. And then third, you have a loan, subordinated bonds, 12% rate of interest, 6,000 is the value. 6,000 multiplied by 12%. So if you will take it, so it is going to give you how much interest? It is going to be $720. If I add all this, it is going to be 2120, I believe, this interest expense. Okay. And now, so we have a 450 plus 1020 plus 790. So it is going to be 2260. What is the total, guys? Just cross check. Its total is available here. No, 2190. If you will add all this, 450 plus 1020 plus 720, it's 720. So maybe I made how much I wrote? 450, 720. Okay, not 90. 720. If I'll add here, it is going to be 2190. 2190. Just please recheck. So 2190. So if you will solve it, 10,000 divided by 10,000 divided by 2190. So answer is 4.57 times. So this is the answer. So 4.57 times. So B answer. Okay. So now I'm showing you other question. See, calculation could be easy. Now let's have a look to this question. Now I told you this point already. They're saying that a debt to equity. You know, I told you there is a relationship between debt to equity ratio and debt to asset ratio, right? If this ratio will increase, this ratio will also increase. If this ratio will decrease, this ratio will also decrease. So they're saying debt to equity ratio is lower than, no, debt to equity ratio could be higher or equal, That's it. It cannot be lower. So they're saying debt to equity ratio lower than or equal to debt to asset ratio. It could be equal to, but it is not lower than. So it's incorrect option. Again, debt to equity ratio is not correlated with the debt to asset ratio. No, it is correlated. I told you if this ratio will increase, this will also increase. If this will decrease, this will also decrease. It is correlated. Third, so debt to equity ratio is higher than or equal to debt to asset ratio. Yes, this is true option. This is the option. And debt to equity ratio about the same as the debt to asset. No, it's not the same because denominator is different. Okay, guys. So it could be higher or equal to debt to asset ratio. So answer C is correct answer. I hope so, guys. Please, mostly questions are tricky, right? Now here we go. We have another question. Let's have a look to this question. Again, see, we have to calculate a company's debt to equity. So when you calculate debt to equity, that means both current liabilities plus non-current liabilities. This is what is mean by debt. Okay, I told you term, debt, total debt, liabilities are total liabilities. Four terms can be used interchangeably. Understood. So here we have to apply, we have to calculate debt to equity ratio. So let's read the question. They're saying following information has been derived from the company's financial statements. Okay, so we have some data. They're saying current assets, 640,000. Okay, this is current assets. Total assets is 990,000. Okay. Long-term liabilities how much? 130,000. Current ratio is 3.2. And we have to calculate debt to equity. Okay, for debt to equity, I need current liabilities and non-current liabilities. So long-term liabilities are given 130,000. Great. So what about current liabilities? Current liabilities is not given. So we have to work. But there is a ratio. One ratio is given, which is current ratio. Current ratio formula is what? Current asset divided by current liabilities. And now current ratio answer is given 3.2. And current assets are also given 640,000. It means I can calculate current liabilities. It means how you will calculate current liabilities, I can calculate how. I'll take current liability equals current asset, which is 640,000 divided by 3.2, right? 3 point, because just reversing it, right? Current liabilities I want, this current ratio I will divide here with the current asset. So if I take 640,000 divided by 3.2, it is going to give you how much? 200,000 as current liabilities. Yes, so I found current liabilities, which is 200,000. It means my current and non-current liability total is 330,000. I found it. Now divide by equity. Equity value is given or not? Equity I can calculate if it is not given. How? See, we always see what? Total assets are always equals to equity plus liability, right? Right or wrong? Right. So liability value I already have now because this debt I have calculated now 330. So liability already have. Liability means a debt 330. Total assets are given in the question here 990,000. So can you calculate this equity value? Yes, we can calculate. How? So if I'll take now equity, how I can calculate total asset minus debt or liability. Total asset is how much? 990,000. And that I have calculated 330,000. So my equity value is 990,000 minus 330,000. So this is going to be 660,000 is the value of equity. Okay, so I'll divide it 660,000. So that is 330, equity is 660,000. If you will solve it, guys, what is the answer you got? 330,000 divided by 660. So answer is 0.5, right? Yeah, so answer is 0.5. C option is correct. Okay, guys. So this is how a question is tested. Let me show you one question. Okay, let's do this question here. They're saying that, please look at this question now. They're saying if the ratio of total liabilities to equity, it means it's a debt to equity ratio. If this ratio increases, a ratio that must also increase, that ratio is debt to asset ratio. That should also increase. I told you this point. So it means if debt to equity ratio increases, so what other ratio will increase? The other ratio will be total liabilities to total asset. This is debt to asset ratio. So C option is correct. Guys, this is how question will be tested. I hope so it is clear. If you have any question, you can ask me.